Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, global stocks stabilize after a $1.6 trillion wipeout as investors brace for earnings from Nvidia to gauge whether the AI rally still has momentum. UK inflation eases for the first time in 7 months, lifting hopes that price pressures have peaked just a week before the Chancellor unveils the budget. Plus, Beijing escalates its feud with Tokyo, suspending imports of Japanese seafood and halting approvals for new films in the latest signs their diplomatic spat is actually far from over. So good morning, everyone. Good afternoon. If you're watching us from Asia, I'm here in Singapore at the New Economy Forum. First thing is first, you know the drill. We get straight to the markets. Look, stocks pretty much steady after a pretty bruising couple of days. Traders now, I guess, refraining from taking big bets ahead of Nvidia's earnings later today in what will, I know, be a potential pivotal test for the big tech-fueled rally. The other thing we're watching, of course, is the release from the Fed of the minutes for last month. Traders now seeing less than a 50% chance of a quarter-point interest rate reduction. So you're looking at gold 4,084, and then the U.S. 10-year yield at 4.1212. We're also looking at European markets. Again, they kind of follow, just given all of the tech and Nvidia news, what we're seeing in the U.S. Now, I am here in Singapore. Of course, this is where the latest edition of Bloomberg's New Economy Forum is happening. The event established in 2018 to embrace the historic shift in economic power from west to east, from north to south, by bringing together the best of government and private enterprise from across the globe. So this is the latest, of course, from Singapore, and fears of an AI bubble and market correction have now dominated much of the discussion here in Singapore, with many chief executives and business leaders telling us that valuations had become too high in the sector.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular.
If we're not going to find $2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, given the level of public debt around the world and where taxes need to go to pay for this debt, the likelihood is we're going to have a significant correction.
I tend to agree that if you look at the public markets, there are risks there for sure. You know, we can call it valuation bubble, etc., for sure.
We've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market.
Markets heavily focused on this AI dynamic. You know, are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate. We're going to see the Nvidia earnings later today. That'll be a very important moment for the markets.
Well, let's bring in Ven Ram, our currency and rates strategist from Bloomberg MLive. Ven, such a big day, much talked about here in Singapore, of course, this AI correction. Are equities now stuck in a loop of negative feedback?
Good evening to you in Singapore, Francine. I think that, Nvidia results are going to be the key for the market reaction, as the speakers earlier were saying, because, there's a lot of froth built into the markets. Even despite the past week correction, we are nowhere near reasonable levels on valuations. If you look at the NASDAQ 100 valuations, the mean PE is 30 plus times, so which is not sustainable. The historical sustainable PE for the NASDAQ 100 has been about 24. So there's plenty of froth built into the markets and plenty of expectations built into AI. But we need to remember, if you think about, when mankind first started flying, there was a lot of expectations about surrounding airlines. But, 1 century down, we know that, capital-intensive businesses don't necessarily pay off at the very start. And billions of dollars have been sunk into AI, and we need to know what the concrete payout is going to be for investors, and which is why Nvidia's earnings today will be crucial in that context. But this is a market that has plenty of froth, there's no question. And going into the year end and Thanksgiving next week, I think liquidity is thinning, which is a big warning sign for the markets.
Ven, I know you're one of my favorite BOE watchers. So UK inflation dropping for the first time in 7 months pre-budget. But you actually think that a December cut by the BOE is far from a certainty. Why?
Well, what we have seen is, as you mentioned, 1 month of disinflation for the first time since May. And that's not, as Bailey told you earlier this month, Francine, the BOE is not looking for a lone data point. They're looking for a trend. We don't have a trend with 1 month's data of disinflation. We need to see more of it. And we've also got the autumn budget next week. The uncertainty that will bring, we don't know yet what it will bring. And the BOE has one more inflation print that comes out before they meet next month. So I think there's plenty of uncertainty going into that meeting. So I don't think that the BOE is going to be in any hurry to cut interest rates, simply because services inflation is holding at 4.5%. So with the BOE's benchmark at 4%, if you cut rates now, your real policy rate is going to be negative. And they're already 4 years of chasing 2% inflation hasn't yielded any fruit. And if they cut into a regime where inflation hasn't subsided as much, particularly services inflation, you don't run a real negative policy rate when inflation is running amok. That would be a policy error, and I don't think that the BOE wants to walk into one.
They certainly don't. Ven, as always, thank you so much. Ven Ram from Bloomberg MLive. Now, the world's most valuable company, Nvidia, due to report earnings later today. And, of course, a quarterly report could assure Wall Street that the AI computing boom has room to run or fuel fears that the tech industry is in a bubble. Well, let's bring in our very own Tom McKenzie. Tom, it's actually crazy how much is riding on these earnings. What will you look out for?
Yeah, well, it's a company, obviously, with a market cap of $4.4 trillion US, and combined, of course, a larger market cap than the market caps combined of, for example, the FTSE 100, the entire UK and French markets combined, and by some stretch. What are we going to be looking for? At the top line is really the number of chips that they're shipping. So it's the data center part of the business. That is the AI accelerators. Expectations that they could come in top line with revenues of about $55 billion across the entire business in the third quarter. We're looking at margins, Fran, of 72 to 73%. Really significant margins being estimated. Earnings per share about $1.26. Those are some of the key metrics. By the way, the growth that's being estimated in the quarter that's going to be reporting, you're looking at about a 60% increase year on year. Always, as is always with Nvidia, at least in recent history, it's all about whether or not the earnings can match those sky-high expectations. This is a stock that's trading at about 40 times forward earnings. So can Jensen Huang and the team just assuage those concerns amongst those investors that this is still sustainable, that demand for their chips, for their Blackwell chips, is there now and will continue to be there into 2026?
Tom, thank you so much. Tom McKenzie there with the very latest on what we can expect from Nvidia. So how do you advise clients on how to create growing, stable businesses during times of geopolitical uncertainty, market volatility, and the dawn of a new tech era? Well, my next guest company is in the business of doing exactly that. Well, joining us now is Mohamed Kande, global chairman of PwC. Mohamed, thank you so much for joining us. I mean, your job must be thrilling, but also a nightmare, because these big companies have to deal with disruption, AI, stop and start. 1 minute they're optimistic, the other it's like the end of the world. Like, how do you advise them?
First of all, thank you for having me, Francine. And it's like a nightmare, but it is actually a good nightmare.
Good nightmare.
It's a good nightmare.
So a dream.
It's like we could call it a dream. But the very interesting time that we're living today, I think the last time we experienced such a thing was 25 years ago during the ramp up to the mobile internet. And today, the level of uncertainty is unprecedented, as you can understand, for many companies around the world. And the way we advise them is, first, agility. Yeah. Learning a lot about being very clear on what is happening in the market, understanding the real signals that will drive what they have to do for their business, and to do a lot of scenario planning. The worst thing to do for any company out there is to stop executing their strategy.
But, Mohamed, I mean, I guess the worry is that there's a bit of a stop-and-start situation, is that 1 minute there's optimism and the other there's not. So how do you advise them on spending? And, I hear you, and it sounds so much like common sense, but actually, how do you cut away the noise from everything else?
The way you cut away the noise from everything else is to have different plans and to keep experimenting. Yeah. Many companies about a year ago were waiting to see what was going to happen with the AI bubble, but now no company will have the stomach today to wait for what might happen. The question that companies are asking themselves today is, are they moving fast enough? It's a completely different question, actually.
Yeah, but fast enough into what? Because
Fast
again, there's
enough,
so much money into AI, but what does it become, and how do you see the returns on that?
Fast enough into first adopting AI in how they're running the businesses today. You know, the regional trend for artificial intelligence, for the users of AI, not the Nvidias of the world or the companies providing all the computing power or all the large language models. For the users of AI, the first play was around efficiency, productivity improvement. That's a no-regret move for most of the companies. They might not have had all of the benefit from using artificial intelligence, going on the efficiency game, but they're all trying this. Now, many companies today are looking for AI to understand how can they use AI to reinvent their business. Yeah. They might not have the answer, but they are going to experiment.
Is there a lot of anxious CEOs out there that you have to advise because they're pouring millions, if not billions, into AI, and they're not quite sure how they make a return on that investment?
Absolutely,
it's like a race to be a race.
It is a race that everybody is embarking on, but today it's a very uncomfortable place for many of the CEOs out there, the fact that we don't know what the answer is going to be.
Yeah.
It is very different from what we were experiencing 3 years ago, but we know that we don't have the luxury of time, therefore we have to experiment, make mistakes and learn from the mistakes, but continue to make the investments. That's what we're seeing a lot with the different CEOs. The question is what experiments, what investment they need to make, and how do they learn from them as they keep moving. And nobody's waiting.
And how much does that mistake cost? If you put 20 billion to AI and it doesn't give you the returns that you're expecting, you'd be in trouble with your shareholders.
That's the nightmare part.
But I mean, it's a serious question, right? How do you advise? Do you tell them this is where AI ends up in 3, 4, 5 years? Or do you just try and say, look, whatever your R&D or your spending is, just cap it so that you don't take the whole house down?
Depends on the company, but most of the CEOs that we are dealing with today are making very informed bets when it comes to artificial intelligence. And when you go into the productivity improvement that can be gained by artificial intelligence, there are really no regrets moves that I mentioned because we know what the efficiencies are going to be. What the bets are going to be about is how do they reinvent their businesses to run the businesses differently, or how do they incorporate artificial intelligence in the next generation products and services? And they will be part of their R&D budget that you just mentioned, but it is a calculated bet that many companies will have to make.
How do you see the trade-off between resilience or agility and growth?
The trade-off has to be made because growth is necessary, but resilience is even more important than before. And you become resilient and resilience costs money. That's why the level of investment that need to be made by companies today, as far as what bets are they willing to make today in artificial intelligence to build that resilience. The only way not to be resilient is to wait.
But if you wait too long, then is there a worry that actually you miss out? What's the biggest challenge? Is it actually going fast for these chief executives, or is it betting on the right horse?
It is a race. It is a race to going fast compared to their competition. But also, as you mentioned, are they betting on the right horse? Are they betting on the right technologies? You have so many players in the AI ecosystem today that, depending on where you find yourself in the world, whether you find yourself in the East and the West, you have different choices to make. And that is what we are seeing for a lot of CEOs and the leadership team that we work with. Which players do they need to select? But also, how many bets are they willing to make at the same time? And the future will tell us what the real answer is.
Do you see AI being in a bubble? I know it's more of a market question, but it was explained to me, which I thought was really funny. Like a bubble, if you think about it, is really the thing that you get fired for not owning until it explodes.
You know, it depends where. I know that we have an AI race. I don't know if we will have an AI bubble or not, but it's sure that the valuation that we have today seems to be very inflated. Yeah. But the AI race that we have today, to really understand that race, is only on the supply side of AI, not on the adoption, on the diffusion of AI in the rest of the different economies. That is where we are going to see most of the opportunities when AI is being adopted at scale in the different geographies around the world. That's the future of AI. And I'm an optimist. It happened 25 years ago with the mobile internet. I truly believe that we are now at the cusp of a new industrial age, which we call the intelligence age, where new innovation will play out by using AI, not just by providing AI.
So underlaying all of this is, of course, the nice little hiccup of trade and tariffs. Are we there yet? How much, if you look at the global supply chain, so this could be blocks because of allyships or more thought leadership with aligned interests. Are we 60% of this new world, or does it change all the time?
Unfortunately, Francine, it changes all the time. And that is why CEOs today have to understand what do they have to do, not only to understand what's happening within the confines of the business and outside of their businesses, and be very agile to react to what they run every day. Unfortunately, the world is changing pretty much on a daily basis, and we just have to adapt to it.
How depressed are your big clients? Or if you look at your big clients, who's the most depressed bunch? Is there an industry that are finding it tough to navigate this industry?
Most of the industry are finding their own way into this. Some of them is by the use of generative AI. Some others is about industrial AI, especially the big manufacturing companies, etc. But every company, depending on the industry, have a different play. But I would tell you that pretty much all industries that we support today are looking to adopt AI. Nobody is waiting. The question is not what to do, it's how to do it.
And what region clients spend most? It's very different, actually, sitting in London, where I'm usually in the studio, sitting here in Singapore, and then being in the US. Is there a region that's a little bit more optimistic about their future?
I think Asia is very optimistic. And I'm also very optimistic for Asia when it comes to the adoption of AI. Again, it's not just providing the computing power and the language models. It's about the adoption of AI at scale.
But you also have Chinese manufacturing that's coming in. So again, you kind of have a fire that's slowly burning. So there's maybe a bit more optimism, but they're also not overjoyed about these changing dynamics.
The change of dynamics are going to give more choices to the users, though, if you have multiple technologies coming in. And depending on where you find yourself in the world, choices might be a good thing for the different companies.
Okay, an interesting conversation. Thank you so much, Mohamed. Kande, the global chairman of PwC. Now, coming up, a pivotal test for big tech with Nvidia earnings set to land tonight. More on what the make or break moment could mean for the AI boom. That's coming up next, and this is Bloomberg.
November 26th, Chancellor of the Exchequer Rachel Reeves delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
The conversations that matter and the insights you need. This is a pulse. I'm Francine Lacqua at the Bloomberg New Economy Forum here in Singapore. So with Nvidia's results expect to land after the closing bell tonight, investors bracing for the clearest read yet on the strength of the AI boom and whether the rally still has the firepower to drive markets higher. Now, the chipmaker is expected to post more than 50% growth powered by surging AI spend from Microsoft, Amazon, Alphabet, and Meta. Now, for more on the AI rally, I'm joined by Jack Selby, Managing Director of AZVC, or AZVC, if you're US-based. Jack, so good to speak to you. AI, I mean, it's the big stress, right? Everyone's focused on Nvidia. I know you can't talk too much about Nvidia, but it's kind of crazy that it makes or breaks the market as a whole, full stop.
Yes.
Are we in a bubble?
I very much think we're in a bubble. I think this may be the mother of all bubbles, dating back to our time when we started PayPal many moons ago. We've seen some cycles over that period, and this one seems like it's by far the largest bubble of that period.
And this is what, just because it's difficult to get a return on all the investment going in. I mean, it's difficult to define a bubble, and two, the secret is to know when it bursts.
Sure. I mean, it's one thing to call the bubble itself, because that seems like a consensus opinion at this point. I think it's much more interesting to talk about what those possible catalysts are. But to go back to your earlier point, what I think is different about kind of this AI innovation is that it's very, very, very CapEx intensive.
Right.
Unlike other innovations in the past. And so it's still an amazing innovation, but the inputs that it requires are very, very expensive, and they scale in a linear way. So even with ChatGPT-5 today, it still takes as much power and energy and chips and cooling as it did with ChatGPT-4 and 3 and 2. And so it's a one-for-one linear scale. And so it's very, very expensive.
So, Jack, I mean, what does that mean? That CEOs will just have to get used to the idea that they won't necessarily get a return on their investments? Or at some point, is it really going to be able to be monetized?
Well, it's a difficult question because the valuations are so price forward
Yep.
So not to pick on any specific companies, but these valuations are such that they're almost 5, 10, 20 years forward. And to pull them back today and try to justify them with today's allocated dollars, I think is just getting harder and harder. And that's a very difficult question for CEOs and the like to make.
But why? Because it's difficult to value, or people get caught up, it's misunderstood? I mean, again, it's really difficult to talk about, valuations that are priced to perfection. But what do you think the underlying cause of it is?
Well, everyone likes to cite the MIT study about how AI is supposedly not having the miraculous impact on productivity that we all thought we were getting. So I think there's maybe an open question about what that productivity gain really is. And if you compare that with very rich valuations, that's a difficult pairing. And so as we get forward into this bubble-like period, it becomes an even more difficult question as a capital allocator in terms of whether you continue to shovel cash into this potential inferno.
Where are you, this potential inferno? This is like, we're not mincing words. Where are you putting your money?
Well, so I run a venture capital firm in Arizona, and so it's kind of the opposite side of this bubble, if you will. And so if you get outside of the 3 states in the U.S., so that's Massachusetts, New York, California, those 3 states last year took down 75% of all venture capital spending. And so this year, obviously the year's not over, but that number will probably be north of 80%, may even be as high as 90%. And so the glass half full, though, on the other side of that phenomena is if you get outside of those 3 states. So if you go to those other 47 states, which, by the way, is where 80+% of the U.S. population lives. So 250 million plus people live in these states. The valuations are relatively cheap. And so the entry point from a valuation perspective is quite good. You can coach those companies up like you do in any sort of normal venture capital context, and then you can take them by the hand to all the friends you may know on Sand Hill Road or the equivalent in these coastal states. So I think in the backdrop of this AI bubble, trying to play directly is very difficult, especially at these valuations. And then getting on the other side of it in these geographies that are not quite so inflated, I think is a potential strategy.
So what are you excited about? Is it AI adjacent? Is it payment? Like what kind of industry are you looking at? Or specific companies?
So actually, I think it's different. So I think one thing that's remarkable about AI, again, trying to be glass half full, and I don't want to sound like a Luddite, is that AI has, sitting here in November 2025, become a ubiquitous, pervasive ingredient that you see in almost every single startup company as a recipe. And you see that not just in Palo Alto, but you see that in Fort Worth or Wichita, Kansas, or Phoenix, Arizona, where I live. And so the fact that AI has become so ubiquitous so quickly is really remarkable. And I would say if you had to assign a force multiplier number to what AI helps you achieve, it's probably somewhat on the order of 10x. Yep. So in other words, you can achieve 10x more revenue than you could otherwise, all things being equal. And then also you can do that in terms of overhead and costs being 10x lower. So that's a huge, huge improvement. So going back to what we said a moment ago, that's probably the biggest force multiplier we've ever seen in terms of technology innovation in the last 30 years. Now, is that worth $500 billion in some contexts? I don't know.
What happened? You called it an inferno, which I imagine is when the bubble bursts, right? If there's a huge market correction.
Yes.
What does it mean for your investments? At that point, you deploy more cash to support some of, the companies that may struggle but that have good value? Is it a buying opportunity? So
I think pure play AI, that is the domain of the coasts. So private tech, pure play AI, I would argue is uninvestable. So if you want to have that exposure.
Now and forever or just now?
Now, I don't know, I can't predict the future. But sitting here today, I think it's uninvestable. And if you really have to scratch that itch, you should just go buy Alphabet or buy Meta or buy Microsoft. Again, not investment advice, but if you really have to feel like you have to participate, why wouldn't you invest there? Because you have instantaneous liquidity. It's not a pure play, it's more of a blunt instrument. But in terms of evaluation, I think it's much more reasonable. Okay, and what is there something that you would be selling off? No, I think it just in terms of if you feel like you're compelled to participate, which no one is, because again, I think it's ubiquitous. It's a force multiplier for all these different companies, not just in Silicon Valley, not just in the coast. So it's good for all of us. It's just a question of whether the valuation is justified. Jack, thank you so much for coming on. Jack Selby there, AZVC Managing Director. Coming up, we speak to Barclays' Brad Rogoff on stress in the credit markets. That's next, and this is Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua at the Bloomberg New Economy Forum here in Singapore. Now, global stocks stabilize after a $1.6 trillion wipeout as investors brace for earnings from Nvidia to gauge whether the AI rally still has momentum. UK inflation eases for the first time in 7 months, lifting hopes that price pressures have peaked just a week before the Chancellor unveils the budget. Plus, Beijing escalates its feud with Tokyo, suspending imports of Japanese seafood and halting approvals of new films. In the latest signs, their diplomatic spat is far from over. So President Donald Trump said he would formally designate Saudi Arabia as a major non-NATO ally. Now, this comes as the kingdom made a vague pledge to increase investment in the U.S. from $600 billion to around $1 trillion.
$1 trillion will be the amount invested in the United States or committed to invest in 1 year. So I'm here 9 months. We're up to almost $18 trillion.
The agreement that we are signing today in many areas, in technology, in AI, in earth materials, magnet, etc., that will create a lot of investment opportunities.
So you are doing that now. You're saying to me now that the $600 billion will be $1 trillion.
Definitely, because what we are signing, it will facilitate that, and
I like that very much.
Well, let's bring in Honor Aunt, Bloomberg's managing editor for the Middle East and Africa and North Africa. Honor, look, there was a lot in the press conference. There was a lot in that meeting. What was actually announced during the Trump MBS get-together?
Francine, they finalized a range of agreements that they said will strengthen or deepen the U.S.-Saudi strategic partnership. The first and foremost, they signed a U.S.-Saudi strategic defense agreement under which President Trump approved sale of F-35 fighter jets to Saudi Arabia. And also that includes an agreement that will allow Saudi Arabia to buy around 300 military tanks from the U.S. In addition, and equally notably, the two sides signed a memorandum of understanding on AI. This was very scarce in details, but we believe this memo will soon be followed by a firm agreement that will allow Saudi companies, including state-backed Humane, to access and purchase US-made chips that will be used in AI facilities and data centers in Saudi Arabia. And possibly most notably that we've just seen, we have seen that MBS, Mohammed bin Salman, the Saudi Crown Prince, pledged to invest around $1 trillion into U.S. infrastructure, technology, and industries. That's up from a pledge of $600 billion that President Trump had secured during his earlier trip to Saudi Arabia this year in May. So these were the highlights of the agreements signed between the two countries during Tuesday's visit to the White House.
Honor, I mean, you could see that there was quite a lot of joking around from the two leaders. What do these deals also say about the changing relationship between Saudi and the U.S., which is not uncontroversial?
Well, this trip by the Saudi de facto leader, Crown Prince MBS, to the White House allows both sides to claim major victories, wins, I think, after the trip. For MBS, obviously, it caps a years-long process whereby he went from, in Joe Biden's own words, from being a pariah to a key U.S. ally. And all the deals that he signed with President Trump sort of cements that position in the eyes of the public. For President Trump, I think, which was very clear from the White House statement overnight on what's been accomplished during this trip, the major takeaway, the major win is that these deals will allow him to show to the American public that whatever dealings he is in with foreign leaders, he is putting America first, and all these pledges, investment pledges that he received or secured from MBS will directly it will result in spending by Saudi government, and the money to be spent will flow directly into American communities, into his own words, supporting American jobs and American industries. So that's the key takeaway for both leaders from this trip, and it obviously, the end result is that it results in this visibly stronger relationship that also allowed President Trump to deliver on his election promises for lower energy prices, because Saudi Arabia, the single largest oil exporter in the world, did play a major role in driving down oil prices. Brent is down about 14% this year, and that's the agreements definitely cements that relationship that helped President Trump so far in his second term.
Yeah. Honor, thanks so much. Honor Onther, Bloomberg's managing editor for the Middle East and North Africa. Now, the U.S. Senate is moving to clear a House-passed bill forcing the Justice Department to release its Jeffrey Epstein files. The House approved the measure 427-1, signaling strong bipartisan support despite President Trump's earlier opposition. Now, President Trump has since relented, though he could still delay the release of some documents as he orders new investigations into Epstein's ties to the Democrats. Now, the Apollo Global Management Chief Executive Mark Rowan has downplayed Jamie Dimon's concerns that there are cockroaches in credit markets. On a panel discussion here at the Bloomberg New Economy Forum in Singapore, Mark Rowan said he did not see anything that is, quote, systemic.
The size of the private credit market, as I see it, is some 41 trillion. Most of the market is investment grade. A fraction of it, some 2 trillion, is below investment grade levered lending. And so much of the focus is on this notion of levered lending and the tricolors and the first brands. And if you think about what's happened, the shock from tariffs has now adjusted into the economy. The shock from high rates has now adjusted into the economy. Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
Well, we're now joined by Brad Rogoff, Global Head of Research at Barclays. Brad, thank you so much for joining us. Look, credit has been like the boogeyman, the spooky thing that's been, going on in the markets. As Head of Research, how much should we worry about something fundamentally wrong, maybe systemic in the markets?
Yeah, so look, everyone's focusing on that, yet if you look at where credit spreads are today, they're still in the bottom quintile of where we see credit spreads. So, I guess the market overall isn't maybe as focused as we would see just from reading news stories, et cetera. Now, all of that said, there are areas of the credit market that are under more stress today than they have been over the last few years. You guys just played some quotes leading into it. And while we can find some of those, and I do think there are areas that are concerned, and we can talk a little bit more about, if I take credit markets as a whole, overall, we feel pretty good about the fundamentals of the underlying companies.
Brad, when you look at, some of the worries about underwriting, for example, the debt and things like that, what changes? Again, where would you see some of the nasties?
Yeah, and so private credit markets are something we certainly need to pay attention to, because that is very different. The makeup of those private credit markets, as well as the size, are very different than we've seen in any other cycle. So where there are examples of leveraged lending, and it used to be a loan that was done in public markets, and now it's a loan that's done in private markets, is there a bit more leverage? Is it something to be a little bit concerned about? Sure, but that is quantifiable. We can understand it. We can understand the downsides potentially from that if the economy moves lower. I think where some of the concerns are, and especially some of the issues that have come up recently, is when there's different type of lending, right? When there's certain types of asset-backed lending where these are not ways that we've lent before. There's not a history of defaults and recoveries. We can't model things out the same exact way. And that is late cycle behavior, right? We find more different creative ways to lend. And why is it attractive? Because we lend at spreads that aren't quite as high as you can do in other markets. So I think that's the area, and those are sort of the rocks you want to uncover right now.
Where do you see more distress?
Yeah, I think if we look for more distress, you're going to look at maybe some of the consumer finance type businesses, right? Those are businesses that there's a lot more of the asset-backed type lending and less of a, hey, I'm just assessing one corporate. I can really dig on the balance sheet. I can really look at that type of loan, right? So I think that's an area, and then there'll be sectoral issues, right? And so there are certain sectors that are coming under pressure. Obviously, right now, chemicals is a great example of that. But I think if I had to look for an area, I would probably focus a bit more on some of the consumer asset-backed areas.
Brad, overall, as global head of research, how does your research change into 2026? So, it's very clear that some of the anxiousness that we've seen in the markets is AI, whether it's price to perfection. There's a lot of talk on geopolitics and then inflation that could be much less predictable than in the past. Is it still the same themes for 2026, or do we enter a new phase?
Well, I actually think, let's hit on that AI one for a second, right? Because if we think about what AI has been, for most of this year, it's really been an equity story. If you think about the biggest hyperscalers, it's really didn't matter to credit markets, for example, right? And so when we're spending time on AI, I'm spending time with my equity analysts thinking about it, whether strategists, analysts, whoever. Now, what we've seen in recent weeks is we've seen a backup, especially in the U.S. investment-grade credit markets, and that backup has come because of some huge issuance coming from AI-related, from hyperscalers hitting the market, right? And so what we really have to do as we think forward into 2026 is thinking about all these markets and the interplay, right? Because the cost of financing this is going to be much higher than maybe originally thought. And so far, it's not much higher. It's a bit higher. Then, that does change things a little bit. Now, where I feel a little bit better is if we go back in time and our equity analysts have spent and strategists have spent a lot of time on this, if you look at the companies that are funding the AI revolution, so to speak, versus if you go back to the turn of the century and look at the dot-com boom and who was funding that, the amount of free cash flow these companies have, it's not even close, right? So the ability to fund it is much higher, but they're still going to debt markets to do it. And that's where we're starting to see a little bit of stress. So yeah, from a research side, we're looking at that interplay and trying to use all our resources.
So is it more through the market side, so through the credit side, but also just the business model for it? Or is it a little bit too soon to see the longer term impact it has on the economy, productivity and job losses?
Yeah, and that's obviously been topical recently. We don't have a lot of jobs data, right? But what we've got, we are seeing a little bit of that. And I think what we'll see in 2026 is really, soon, exactly, very, very, very soon. So we'll see some of that. But we also don't want to do too many conclusions, certainly from 1 month of delayed data, or then we'll get 2 months of data. But all of that being said, I think what you are going to see, yes, there are going to be some isolated job losses, but at the same time, the productivity enhancement, and we see it in how we're able to do our research, right? We're able to have the same amount of people. We're able to cover more companies as a result of the increased productivity from AI. So that's probably the first phase. But then there's a question of how quickly we transition to the second phase.
Yeah, so on the release of the data, and again, there's a lot of excitement, I'm sure, on trading floors just because we haven't had U.S. data for a while because of the U.S. government shutdown. We get that employment data, which of course is backward looking, but it's the first set of data that we have on Thursday. What will you read into it?
Yeah, I think it's important to remind ourselves that what we're looking for in jobs data, for example, has changed a lot over the course of this year, right? People weren't satisfied unless you were adding 100,000 jobs a month if we go back to the beginning of this year. But with everything that's changed in the U.S., especially with respect to immigration, the break-even number for jobs data is sort of barely a positive number at this point. It might be 15,000 jobs. And so what we're looking for is going to be a difference between private and public, certainly in overall payrolls, right? Because you're going to see some of the government stuff play out, right? Some of those packages that people took where people were only rolling off now. And so we're going to try and look at those differences and see if, when you kind of look at the private number, if that's dipping into negative territory, I think that would be another signal as to why the Fed might move in December.
Brad, thanks so much. Brad Rogoff there, Global Head of Research at Barclays. Now, coming up, tariffs slashed, investments pledged, the U.S.-Swiss trade deal breaks cover. More on that with Switzerland's State Secretary for Economic Affairs. That's next, and this is Bloomberg.
think the important thing for the UK from an economic perspective is to make sure that its fiscal house is in order, to have the breathing room for investment, both public sector and private sector investment. I think there are clearly some fiscal challenges. There's some political challenges. And I hope that the government can put a budget in place that addresses those kinds of needs.
Well, that was David Schwimmer, the London Stock Exchange Group Chief Executive, speaking here at the Bloomberg New Economy Forum. Now, UK inflation fell for the first time in 7 months ahead of crucial decisions by the Bank of England and the Chancellor of the Exchequer, Rachel Reeves. Now, we're joined by Anna Andrade from Bloomberg Economics. Anna, thank you for joining us. So first of all, inflation dipping for the first time in 7 months. Does this meaningfully change what the BOE does in December?
Hi, good morning. So obviously, an environment of falling inflation is a better environment for the Bank of England, and inflation did fall to 3.6% in October, which is what the BOE was forecasting. So it's good on the surface, and I do think it keeps December rate cut on the table. It will be a close call, but actually, when we looked at the details this morning, and if you compare at least with the September CPI, which was such a game changer, I would say the details were not as benign in the sense that energy was what drove the fall in inflation, and even within services that fell, services inflation fell. It were components like airfares and accommodation, which have been items that the Bank of England in the past has tended to overlook, that sort of drove that fall. So you really didn't see that progress on underlying inflation that we've seen in September. And I think whether it leads to a December rate cut or not will depend on the interpretation of Andrew Bailey's wording in the November meeting. He said he needed to see more progress on underlying, on more progress on disinflation, and it's a bit unclear whether that means, inflation is coming in line with the forecast, in which case December rate cut is game, but it can also mean more progress on underlying price pressure, and we just haven't seen that yet in this print.
And I mean, how much of a difference does it make on the upcoming budget? I have to say, this autumn statement on November 26th, and people are even talking about it in Singapore because there's so much anxiousness about where this puts the UK.
I mean, I think this DCPI print won't meaningfully impact the scale of fiscal tightening that Rachel Reeves needs to deliver. Obviously, politically, is a much more favorable backdrop to announce tax rises. But I think what we'll need to watch, at least on the interaction between fiscal policy and monetary policy, is what Rachel Reeves does that can influence inflation. So essentially, she has said that she wanted to sort of tackle and ease the cost of living. And there's been rumors that she could reduce the VAT on energy bills. If she does that, that could mean sort of a drop on headline inflation of 0.3 percentage points, and that would be obviously very welcome for the BOE. I mean, if she does that, then we think a December rate cut is sort of more or less like a done deal. But obviously we'll need to wait for the details to see what happens.
Anna, thanks so much. Anna Andrade there from Bloomberg Economics. Now, of course, it's going to be a big week for the UK. We want your questions. Join Kit Reese on the Bloomberg Market Today blog for a special UK budget Q&A at 11 a.m. London time. That's in about an hour and 5 minutes. They'll discuss what could be in store and what that means for your money. So send your questions to markets today at Bloomberg.net. And of course, the UK Chancellor Rachel Reeves expected to deliver her budget at 12:30 p.m. London time next Wednesday. Viewers in the UK and Europe can join us for full coverage and analysis on the day. Now, Switzerland's top trade diplomat has expressed her country's heartfelt desire for UBS not to move abroad. Well, I spoke to Helene Budliger Artieda, director of Switzerland's State Secretariat for Economic Affairs, and I began by asking her about the possibility of extra taxes on streaming services like Netflix.
We don't know. We have a law on that. And, Switzerland is a multicultural, multilingual country. So for us, it's important that, some of our national languages are actually on the list of being endangered languages. I don't know if you ever heard of Romansh. So we have roughly more than 30,000 Swiss speaking, and it's important that content for them gets produced both on TV and in radio. So we're coming from a different angle. I don't think that we want to, in any way close up the market, but I think for us it's important that we can, lift that multicultural and multilingual identity. So who knows? Who knows?
But so the government won't necessarily push to actually get that law changed?
No, not necessarily, but, it's going to be a negotiation. Yeah. There's going to be two sides on that table, and we feel that we're ready, and we feel that wherever we will not be able to comply or to reach an agreement. I think we'll have good arguments, and I have to say I've been now, I think, a record time to the US, and we've always had very constructive and very positive discussions, of course robust. There are interests at stake, and the USTR has an excellent team, and they're quite tough negotiators. We think we're the same, so we shall see. But that is really for the second phase. And again, I have to repeat, we will, of course, follow due process according to Swiss constitution, consult the mandate. Once we have the mandate, do the negotiations, and then go through a ratification process.
UBS was once again in the news with, we understand, the chairman of UBS speaking to the Treasury Secretary of the US about possibly moving headquarters to UBS. Your reaction?
I'm not aware of. I would think that such an important chairman of such an important bank would have a conversation from time to time with U.S. Treasury, but I cannot confirm that that is actually happening.
Do you know if they're thinking about it? How disastrous for Switzerland would it be if they were to move headquarters?
We love UBS, so we really would like them to stay.
That was Helene Budliger, Artieda, the director of the Switzerland State Secretariat for Economic Affairs. Now, we have plenty more top interviews to bring you from the new Economy Forum tomorrow, including Adina Friedman, the NASDAQ chief executive, Ralph Arndt, the chief executive of the Australian Government Future Fund as well. Of course, geopolitics left, right and center here at the new Economy Forum, including this diplomatic spat between China and Japan. Now, what started as a row over Taiwan has now resulted in Beijing suspending imports of Japanese seafood and halting approvals for new films. Joining us now is Roz Matheson, Bloomberg's chief Asia correspondent. And Roz, thank you so much for joining us. This does not seem to be escalating at all. So what are the latest moves from Beijing and from Tokyo?
Well, the challenge is we're kind of at a stalemate. So we had diplomats from China and Japan meeting. From the China side, their reading is they don't think the meeting went particularly well. Japan is saying we've explained the Prime Minister and her comments around Taiwan, which has been the cause of all of these renewed tensions, and that she was talking in a very hypothetical way. But China's saying, fine, but what we would need her to do is to retract the comments, and she's not about to do that. She's a very new Prime Minister. She's cut from quite a strong cloth. She needs to show, from the outset that she's being quite strong. So she's saying we're explaining, these comments, but we're not looking like we're going to retract them. So China wants that. Japan's saying that. How is the off-ramp going to come in all of this? Because as you say, in the meantime, we're seeing further measures from China, at least, to penalise Japan. And that's a very familiar playbook for China, is to use trade as a lever. It's done that against some of its neighbours in the past, including, Taiwan, Japan, and also South Korea. And so is it going to escalate in a way that is more meaningfully going to impact the economies?
So is this just symbolically bad news, or does it actually have economic ramifications?
Well, it could potentially. For now, it doesn't seem to be. Seafood exports had been suspended already. They were only just starting to resume, and so they're very, very low. Most Chinese tourists who go into Japan these days do not go in tour groups. They go under their own steam, and so it's a lower impact event. But the big question is, does China really ramp it up and start to include things like rare earths, critical minerals? And there you're getting at something that would fundamentally be damaging potentially for Japanese companies and for the Japanese economy. So for now, it's actions that are obviously meant to send a signal around beef, seafood, films, as you say, tourism, travel, business travel as well. Those all have some kind of impact, but they're not moving yet, at least, to the big one, which would be rare earths.
Roz, we had a good day here, the first day at the New Economy Forum. What are you most looking forward to tomorrow and the next day?
Well, it's interesting to hear the conversations around the first day. Obviously, what's happening around the world is being discussed here. The wobbles that we've seen in the markets lately, are those healthy washouts? Obviously, we've got Nvidia earnings, and so people are looking at the outlook for the financial markets. A lot of conversation around this debate around de-dollarization. Is it real? I mean, most people here so far speaking today seem to say fundamentally they don't see the case against the dollar continuing its dominance, and a lot of conversation around AI, which is something everybody wants to know the future of AI because it goes across everything: business, trade, politics, and security.
Yeah, and all the market traders are like this, waiting for the Nvidia earnings. Ross, thank you so much. Ross Matheson, Bloomberg's chief Asia correspondent. Up next, Bloomberg Brief, and this is Bloomberg.